Good evening, everyone. This is Vrinda Vakharia, the moderator of this webinar. We are delighted to welcome you all to this webinar, which is being organized by Continuing Professional Education Committee of ICAI. It is my pleasure to be a moderator for the webinar on inverted duty refund under GST and issues in taxation of trust. In a short while, we will start this webinar. First, I would like to apprise you about CPE committee. In today's ever changing professional scenario worldwide, the biggest challenge the professionals face is how to stay on the top of their game while adapting to new requirements and norms. Therefore, it is imperative to aim to be up to date to offer unique guidance, influence others with their innovative approach and expertise. It is also vital to stretch old ideas beyond traditional boundaries to create new perspectives. In this context, continuing professional education facilities professionals to maintain, improve, and broaden their knowledge, skills, and expertise required to achieve their professional goals through webinars and seminars, etc. The program for this evening is as follows. We have two sessions of 1 hour each. The topics are first, inverted duty refund under GST, second, issues in taxation of trusts. Our eminent speakers will talk about above mentioned two emerging areas of professional interest. I would like to invite first speaker of this evening. The topic is inverted duty refund under GST. Please welcome our speaker C. Anish Goel. I would like to introduce him as Mr. Anish Goel became chartered accountant in November 2011 with AIR 19 in CA final exams, and he has been honored with National Taxation Award 2021. He has 14 plus years of experience in indirect taxation, covering GST compliances, litigation, and search cases, and is specialized in GST, advisory services, and industry insights like latest developments, ensuring cutting edge advisory services. He is regular contributor to leading tax publications and a frequent speaker at numerous industry events and has represented clients at high levels, including the group of ministers, finance ministers, and authorities litigation and dispute resolution. So let's give the stage to our first speaker, C. Anish Goyal sir. Sir, the ground is yours now.
Thank you, Vrinda Madam, for my kind introduction. Before starting the webinar, I would like to thank CPE Secretariat for giving me this opportunity to speak on the topic of GST refunds of accumulated input tax credit due to inverted duty structure. Before starting, I would just share my presentation and would start. Yes, hope my screen is visible to everyone. So yes, thank you. My topic for the day is refund of GST due to inverted duty structure. Friends, we all know that the accumulated input tax credit under GST can be claimed as refund. And I am from the city of textile Surat, and textile industry has been put under the inverted duty structure. So we have selected this topic so that I can give more practical insights on the refund provisions regarding the inverted duty structure. Coming under the CGST law, the provision which governs the mechanism of giving refund under inverted duty structure are section 54 to 58 of the CGST Act, that is chapter 11 of the CGST Act, which specifies which is the enabling provisions to grant refund. The procedures has been mentioned in Rule 89 to Rule 78 capital A regarding the manner and methodology, the manner of calculation of refund has been given in Rule 89 to Rule 78A. Moving forward, there are various circulars which have been issued from time to time, which clarifies the methodology, the documentation, the systems, how to claim refund, and these are all the circular which we will go through today. Circular 125, 135, 181, 197. These are the main circular which I have highlighted, in which we shall have a deep insight. Moving forward to section 54. Section 54 says any person can claim of refund of any tax, interest, or any other amount. Section 54 uses the word any person. It doesn't uses the word taxpayer, a registered SSC. So if any person who is eligible for any refund of any tax, interest and penalty can apply under section 54, the application has to be before the relevant date. The relevant date is 2 years from the relevant date. We will see the definition of meaning of relevant date depending on the type of refund application which needs to be made, and it is in such form and such manner as may prescribe. The form and manner, as I told, is in Rule 89 to Rule 797 capital A. So this is the enabling provision section 54, which enables the grant of refund. The types of refund under the GST law is, of course, which we will deal in detail, inverted duty structure. Second type of refund is zero rate supplies. Zero rate supplies means supplies of goods and services outside India, that is export of goods or supply to an SEZ unit. So these are called the zero rate supply of goods or services for which the refund can be claimed under the GST law. Moving forward, it is refund due to deemed export. Say if a person is supplying goods under advanced license authorization, under EPCG, or various this kind of schemes, then it will be treated as deemed export, and the procedures of refund can be claimed under these circumstances. Moving forward, it is claim of refund from electronic cash ledger. Say if amount is lying in electronic cash ledger, including the amount accumulated in electronic cash ledger because of TDS and TCS provision. Next type of refund is refund of excess payment of tax. If due to any reason any tax has been paid in excess. Next is refund of tax paid on intrastate supply, which is subsequently treated intrastate, or vice versa. Say we have paid tax at CGST and SGST, treating as an intrastate supply, but the sale is an interstate supply. Under those circumstances, also refund can be claimed as per section 77 of the CGST Act or corresponding section 19 of the IGST Act. Further type of refund is, of course, refund on account of any assessment, provisional assessment, appeal. If any refund arise on account of those, then refund can be claimed. Lastly, if not covered under any other category, any stated categories, if refund is on account of any other reason, then also refund can be claimed. But our focus in today's webinar is refund of accumulated ITC due to inverted duty structure. Inverted duty structure refund is allowed for all goods and services except the goods or services which has been notified by the government. So in principle, if any goods or any services you provide, say we talk about goods, say if any goods you supply and the rate of tax on your outward supplies is less than the rate of tax on your inward supplies, that is inputs. If your rate on tax on inputs is more and the rate of tax on output is less than your inputs, then it is a case of inverted duty structure, and in principle refund is allowed under a GST provision, except a negative list which has been given by the central government, by the CBIC by notification number 5 of 2017 for goods, except those goods which have been listed in 5 2017, which has been amended time to time by notification number 29 2017, 44 2017, 20 2019, 9 2022, and 20 2023. For except for all these goods which have notified by these notifications, for all the goods refund is allowed. Which are the goods which have been notified for which refund shall not be allowed, even though they fall under the inverted duty structure? The list as per the notification are: firstly, the edible oils falling under HSN 1507 to 1518. Secondly, coal, lignite, PET. For this, refunds are not allowed. For this, refund are not allowed means if you are engaged in outward supply of coal, if you have supplied any coal, and on coal say you are paying 5% GST, and for supplying coal you have procured some inputs on which the rate is higher, then because the coal is restricted as per notification number 5 2017, refund shall not be allowed in respect of outward supply of coals. But if you are, say, you providing an outward supply of any other material, say you are providing an outward supply of fabrics, you are manufacturing fabric which falls under 5% GST, and you are purchasing coal for using in your boiler which have been installed in your factory, then the ITC of coal and refund, and for the purpose of refund calculation, the ITC of coal would be included. So the restriction is given this notification. If you are doing an outward supply of these goods, then it is restricted. Further restriction is woven fabrics of different types falling under this HSN, knitted fabric of twine. An interesting exception has been recently brought wide in the year 2023 of imitation jari thread. If you are engaged in outward supply of imitation jari thread or yarn, for which the rate was reduced to 5%, it is specifically stated that for the SECs who are engaged in outward supply of imitation jari thread or yarn, for them, if their input is polyester film or plastic film, specific refund of polyester film or plastic film shall not be allowed when used for outward supply of imitation jari thread. That means that they are eligible for their other inputs used in outward supply of imitation jari thread or yarn, and not of polyester film or plastic film. Fabrics cover under 5801, narrow woven fabric under 5806. So these are all the goods which have been restricted, for which the refund of inverted duty structure shall not be allowed in case your outward supply is the stated goods. For services, they have disallowed the credit. They have disallowed the credit as per notification number 15 2017. So as per notification number 15 2017, they have restricted the refund of accumulated input tax credit if your outward supply is service of construction of a complex or a part thereof. Say you are engaged in a construction of building, a construction of a commercial complex, for which you are charging 12% tax on your commercial complex, and your input, say it is steel, cement, having an input credit of say 18 to 28%, even though your output falls in the inverted duty structure, but as per the restriction in 15 of 2017, we are not allowed to take refund. The interesting part here is, it is the restriction is in part of construction service. That means if a builder is providing outward supply of construction service along with the value of land, the restriction is not of works contract service. Say if I am providing a works contract service, then if my works contract service fall under inverted duty structure, then I am eligible for refund under inverted duty structure, and it is not restricted as per notification number 15 oblique 2017. Moving forward, after seeing the restriction, the manner of calculation of refund amount. The manner of calculation of refund amount has been provided in Rule 89, Sub Rule 5 of the CGST Rule 2017. The formulae given in the said rule is as under. The formula is your maximum eligible refund amount. Your maximum eligible refund amount. This is the formula which was last amended on 5th of July 2022, which says your refund amount will be the turnover of inverted supply of goods and services divided by adjusted turnover into net ITC minus the tax which has been payable or paid on the supply of inverted duty structure into the net ITC divided by ITC availed on input and input service. We will see this formula. We will see this formula by applying a illustration moving forward. So you need to calculate the formula, calculate the refund as per the formula. Give the details along with the refund application in Annexure B, stating that number that containing the details of invoices, the HSN code, and all other particulars as prescribed in the exam in the circular 125 is the master circular for claiming the refund. So the calculation as per the formula is the illustration which I am giving now. Say in this illustration which I have taken, say your turnover of inverted duty supply of goods and services is 5,50,000 and into 5%, 27,500 is a tax which you have paid on supply of that goods and services. So your other turnover, which is not an inverted turnover, say the turnover is 50,000. So total turnover for a relevant period, for a say for 1 month is 6 lakhs rupees, out of which 5 lakh 50,000 is the inverted turnover and 50,000 is the normal turnover. Your ITC on inputs in the example is say 50,000 rupees of goods. On input services is 15,000. So total ITC on input and input services is say 65,000 rupees. ITC on capital goods 5,000 and total ITC is 70,000. So formula need to be applied is inverted with turnover 5,50,000 divided by total turnover 6 lakhs into the tax paid on your inverted duties. Say tax which I have into the net into the net ITC of inputs is 50,000. So 5 lakh 50,000 into 50,000 divided by 6 lakhs minus the tax paid on inverted duty structure, but complete 27,500 should not be reduced. It will be as per the percentage of inputs used vis-a-vis the total ITC of input and input services. So it is 50,000 divided by 65,000 rupees. So it is 45,833 minus to 21,154. The refund in this case would be 24,679. Earlier, prior to amendment in 2022, the refund calculation would be such that the 27,500 is not multiplied by 50,000 divided by 60,000. It is straight 45,833 minus 27,500. So refund would be less. But after amendment 2022, the refund amount has been increased due to change in the formula. We will see how and why the formula was changed in the coming slides. Moving forward to the definition of net ITC. The 50,000 rupees, the net ITC, which we have reduced in our example, is the ITC on inputs during the relevant year. So this is the relevant period for which the refund is claimed. So we need to take ITC of only inputs in the net ITC as per the definition given of net ITC in the formula. Further, your adjusted turnover would be the total turnover of a particular state, excluding the turnover of services which are zero rated, because as much for zero rated supply of services, separate method has been given for calculation of the turnover. So that is to be applied. It is excluding the value of exempted supplies. So the value of exempted supplies would be excluded for the purpose of computation of your adjusted total turnover, including, of course, just zero rated supply of goods or services. This is the formula which has been given and is a definition of adjusted total turnover, which is the total turnover minus the exempted supplies turnover, but it is including the zero rated supplies turnover made during the relevant period. Moving further, after seeing the formula, what is the time limit? Time limit is very important because after the expiry of 2 years from the relevant date, we would not be eligible for the refund of accumulated ITC. And this 2 years would not be extended. There are number of judgment under the erstwhile law which says if time limit is given for claiming of refund, then refund has to be claimed within those that time limit only. Otherwise, your refund would be time barred, and even though you are eligible for refund on merits, but due to the time barring aspect, we would not be eligible for input tax. Would not be eligible for refund of the accumulated input tax credit. So the time period is very important. The time period for I have given 4 5 examples. The time period for first, if refund is arising out of any judgment, then it is the date of communication of that judgment. In case of refund of unutilized input tax credit, the time limit is will start the time limit of 2 years would start from the due date of filing of return. Say the due date of filing of return is GSTR 3B return. Say for the month of November, the due date is 20 December 2024. So for the purpose of computation of time limit of November 2024, it would be 2 years from 20th December 2024. So 20th December 2026 would be the last day for filing of refund application for the month of November. So, in case of tax which is provisionally paid, it is the date of adjustment of tax after the final assessment for any for person other than the supplier, because as per section 54 any person can claim the refund. Even a buyer can go and claim the refund if excess payment has been given by the buyer to the supplier. So for them, the time period of 2 years will start from date of receipt of goods and services, and in any other case it is the date of payment of tax. So the subject in the current webinar is inverted duty structure, that is the refund of unutilized input tax credit. The time limit is 2 years from the due date of return under section 39 for the period in which refund has been claimed. Prior to 2019, prior to amendment in 2019, it was 2 years from the end of financial year in which the refund is eligible. But after amendment in the act by the by the Central GST Amendment Act 2018, it is the 2 years from the due date of filing of your return. So we have seen section 54 claim of refund. We have seen rule 89, the manner which refund has to be claimed, and then we have seen the time limit of refund which we need to claim. Now it is the time limit for the departmental officer also to grant the refund. And if refund is not granted in time, then we are eligible for interest. Interest on delayed refund as per section 56 of the CGST Act, read with rule 94. It says your refund must be credited to your bank account within a period of 60 days from the date of refund application. And if refund is not credited in your bank account within a period of 60 days, then if the refund was due to any order passed by the educating authority, appellate authority, or appellate tribunal, then you are eligible for interest at the rate of 9% per annum. And for any other case, you are eligible for refund interest of 6% per annum. The officer will give you interest if your refund amount is not credited in your bank account within a period of 60 days from the date of application. Normally we are saying it is an indirect taxation. Indirect taxation means as a supplier of goods and services, we do not bear the burden of tax. The burden of tax is borne by our customer, the purchaser, the recipient of goods and services. So, on as a principal understanding, it is that we collect tax from the receiver, from the buyer, and give it to the government as an agent of the government. So, we are a registered person under GST as an agent of the government. So, in principle, the government says that any tax paid by you has been collected by you. And as per Article 265 the Constitution of India, no person can be enriched or benefited from the burden bear by any other person. So, For the refund application, as per the general provision, we need to prove that the refund which I am eligible, I have borne the burden of that amount which I have paid. So there is a concept of unjust enrichment. I have not been enriched by the tax which I have been seeking the refund from the government. So so principally, government has stated that if any amount of refund has been sanctioned, it will go to consumer welfare fund. So consumer welfare fund has been constituted, for which the refund amount will be credited to the consumer welfare fund, and any income, any investment from that fund will be again be credited to the consumer welfare fund. But there are some exception to this section 57. The exceptions are that in the following cases, the refund will be given to the applicant and refund amount will not be transferred to the consumer welfare fund. The cases are that is tax paid on export of goods, ITC, which we are claiming, say, used in the export of goods or services, inverted duty structure. So, any refund which we are claiming of accumulated ITC due to inverted duty structure will not be credited to consumer welfare account, but will be credited to the account of customer. Further, if any tax has been paid for which supply is not provided by us, invoice not been issued, say any advance has been received, on that advance of supply of service we have paid the tax. Now we are not providing any service, we have refunded the advance to the customer, so we are eligible to claim of refund of which the tax we have paid. So for those cases, the unjust enrichment will not be applicable. Further, one more point needs to be discussed. For section 77 case, which I have discussed at the time of discussing the type of refund, say for intrastate supply has been treated as interstate supply and you are eligible for refund, for those cases also the understanding will not be applicable. But in case of inverted duty structure, the government require us to give a declaration, that the incidence of tax has not been passed on to any other person and I as a registered person has bear the incidence of tax. If the refund claim is less than rupees 2 lakh, a declaration from the taxpayer is sufficient. But if the refund amount is more than 2 lakh rupees, then a CS certificate would be required in case of refund. Application is more than rupees 2 lakhs. So moving forward, as stated that the refund application has to be in form RFD01. So RFD01 is the refund application form which have been to be submitted online through GST and portal. And any person who is making an application for refund under the GST law must be subjected to other authentication. His other authentication has to be completed. It was introduced by Rule 10 capital B with effect from 10th of January 2022. So, after filing an application in RFD01 in GST and portal, the application shall be forwarded to a proper officer. The proper officer shall, within a period of 15 days, shall scrutinize the application, its completeness, and the refund is complete with all the documentation. Then an acknowledgement in form RFD02 would be issued within a period of 15 days from date of application. In cases when the documentation is not complete as per the guidelines or circular given in this regard, then a deficiency memo will be issued in form RFD03. So a deficiency will be issued in form RFD03. Moving forward, when a deficiencies memo is issued, when a deficiency is issued and it is communicated in form RFD03, then the applicant need to file a fresh application after rectification of deficiency. So a fresh application needs to be made if any deficiency in your refund application has been found and deficiency memo has been issued by the officer. Now, as we all know, the refund application needs to be made within a period of 2 years from the date of application. So, say if you have made an application just before expiry of 2 years, and the deficiency comes after the expiry of 2 years, then how the first application would be made? Therefore, it has been provided under rule that the time limit of filing of refund application till the date of issuance of deficiency memo would be excluded in computation of period of 2 years. So this is the mechanism of issuing deficiency memo and a fresh application that can be made. Once you have filed a refund application, if you come into notice that your refund application is not proper or you don't want refund, then an option for withdrawal of refund application also be provided in Rule 90 Sub Rule 5 of the CGST rules. As per this rule, application can be withdrawn if you have filed the GSTN portal, but your application has to be withdrawn before the issuance of any provisional refund order. Say in case of export without payment of duty, we get a provisional refund within 10 days in form RFD 04. So before getting a final refund sanction order, before getting a payment order, or before getting an refund withdrawal order, before receiving any notice, if your documentation is complete, but if any points needs to be seen by the officer and needs to be clarified, a notice in form RFD 08 is issued by the officer after issuing of acknowledgement in form RFD 02. If notice has been issued, then you cannot withdraw. Your withdrawal should be before the issue of notification, before the issue of any withdrawal, refund withhold order, payment order, sanction order, or the provisional refund sanction order. Your application has to be in form RFD 01W form online. Once you withdraw your application, say at the time of filing of refund application, immediately when we submit our form RFD 01, the our electronic credit ledger get debited to the extent of refund claim. If any deficiency memo is issued, then the amount get recredited to our electronic credit ledger. Then again, at the time of filing of fresh application, again the amount get debited. Similarly, in case of withdrawal of refund application, also, if we withdraw the amount, then if we withdraw the refund application, then your amount will be recreated in your electronic credit ledger in case of inverted duty structure. In case of any other refund application where we have made the application by debit of electronic cash ledger, then your amount will be recreated. Say you have applied for refund of rupees 10,000. The refund sanctioning authority has sanctioned the refund of 8,000 rupees and rejected the amount of 2,000. So that rejection amount of 2,000 can also be recredited to your electronic credit ledger. That recredit will be made by issuance of form GST PMT 03 of but the form GST PMT 03, this order will be issued when your refund application shall be deemed to be rejected. It is rejected, it will be deemed when it is primary, when it is finally rejected. Once you have filed the appeal and your appeal is rejected for the 2,000 rupees which have been rejected by the executing authority, you have filed the appeal before the rejection of rupees 2,000 and your appeal is rejected, or you give an undertaking in writing to the proper officer online in GST portal that for the rejection of amount of 2,000 rupees you shall not file an appeal. For these two circumstances, the amount of rejection amount of 2,000 will be created to your electronic credit ledger. Your refund sanction order, as I told, it will be in form GST RFD 06 along with the payment advice in RFD 05. And a rejected amount will be credited to your electronic credit ledger or cash ledger, as the case may be, by issue of form GST PMT 03. If any demand is outstanding against you, then the amount can be adjusted by withhold order in form GST RFD 07. Of course, thus the principle of natural justice, opportunity of principle hearing, there those all procedure needs to be made by the officer before withholding any order. He will issue a notice, then you need to reply, and after that a form withhold or refund withheld order would be issued in part B of order GST RFD 07. So these all are the rule which I have which I need to discuss. Further, coming to circular number 125 44 2019, which which talks about the fully electronic process of refund. And refund will be the maximum refund will be, of course, as per the formula which we have discussed as per rule 89 sub rule 5, or the balance in electronic credit ledger at the end of tax period for which the refund is claimed, or the balance in the electronic credit ledger at the time of filing of application. Moving further, the manner of debit of the credit input tax credit amount at the time of filing of refund application would be firstly integrated tax to the extent to the balance available, then it is central tax or state tax equally if available, otherwise in the proportionate as per the balance. And uh, of course, as per that, as I discussed, if any deficiency memo is issued, then fresh application needs to be needs to be within the period of 2 years only. Moving forward to next important circular 135. Circular number 135 removed the restriction on clubbing of refund application across various financial year. So, say if you want to apply a refund for say January 24 to June 24, when the financial year is changed in March 2024, then also you can apply one refund application across the financial year. This restriction was removed after the direction of Honorable Delhi High Court in case of Pitambara Books Private Limited, that that refund can be claimed by clubbing of tax period across different financial years. As earlier in the refund application, we need to submit the statement of invoices, giving details of invoices. After circular 135, in addition to the statement of invoice, we are also in requirement of submitting HSN SSC code as the nature of all the input supply which I have received, because the department was facing a practical challenge whether it is capital goods or not in at the time of verification of refund application. Therefore, this requirement was built, and annexure B, which we upload online was modified accordingly. Moving forward to one circumstances where circular 135 restricts. Circular 135 restricts the refund of accumulated input tax credit in cases when the credit is accumulated on account of change in rate of tax. Say, say recently on imitation jari yarn, the rate was reduced from 12% to 5% on 1st of October 2023. Now there may be a situation whether the taxpayer would have stock of 12% purchase goods, and now he is selling after 1st of October 2023 at the rate of 5%. So it is a clear case of inverted duty where the rate of input earlier was 5%, 18%, and now the rate of output is 5%. So this circular restricted the input tax credit on the same supplies where the rate or input, where the input and output are same supplies. But in case of BMG Informatics Private Limited, Honorable Guwahati High Court has struck down relevant para 3.2 of the circular 135 with a specific finding that section 54 3 subsection 2 provide no such restriction. Section 54 3 subsection 2 clearly says when the rate on inputs is higher than the rate on output, you are eligible for refund, even though it is the same goods which you have purchased and which you have sold. So this judgment would help in those cases. BMG Informatics Private Limited. So moving forward to another important circulars, that is circular number 110 29 2019. This circular says if any taxpayer has inadvertently filed a nil refund application, then either he can withdraw the application before issuing of any order, or he can reapply under any other category for the same tax period, provided no refund claim for subsequent period has been filed under the same category. So this restriction has this condition has been brought for which refund can be applied under any other category. And after introduction of Form GSTR 2B for input tax credit, this to be reconciled with Form GSTR 2B at the time of filing of refund application. It has been clarified in Circular number 197 dated 17th July 2023. So these were the important section circulars which needs to be taken care of and the procedures. Moving forward to the last leg of the webinar of this session, it is case laws, important judgments as regards the inverted duty structure refund. 3 4 judgment I would discuss it as I have 10 15 minutes to go. Firstly, firstly is notification 20 2018. At the time of allowing refund to fabrics, falling under chapter 5407, 2018 notification inserted a condition that accumulated input tax credit must be lapsed. Notification 2018 granted the refund from 1st of August 2018 with a condition that your balance of input tax credit as on 31st July 2018 needs to be lapsed. So this matter was challenged in case of Sabnam Petrophils Private Limited before the Honorable Gujarat High Court. The Gujarat High Court specifically struck down the lapsing part of Notification 20 2018 by stating that as and when the credit needs to be lapsed, their provision is specifically in the GST Act only in section 17 subsection 4 or 18 subsection 4, where the legislature wanted to lapse the credit. It has been exclusively provided, and a notification cannot have the power to lapse. There is no such express provision made under section 54 subsection 3 that any that this section does not give any inherent power to the government to lapse the input tax credit which is utilized. It is trite law that the legislation must be in conformity with the provision of parent statute. Therefore, the opening paragraph of notification 5 2017 of opening paragraph of notification 5 2017 which have been inserted by notification 80 2018 is invalid and liable for struck down. The department has gone before the Honorable Supreme Court in this matter, and the case is pending before the Honorable Supreme Court in case of Sabnam Petrophils Private Limited. Moving forward to another important case is refund of input tax credit due to your other inputs. That means, say if I am supplying a material, see if I am supplying our garments or any product at the rate of 5% duty, but our input are such that major fabric is 5% for manufacturing of that garments, but there are other inputs, say packing material and other inputs on which the rate of duty ranges from 5% to 18%. So my major input is 5%, but the credit is accumulated due to use of others other inputs such as packing material, stores, spare parts, etc. So whether GST on output supplies refund can be taken under those cases when the rate of input on a rate on other inputs is higher than the rate on output, whereas the rate of main input is same as rate of output. So in various judgment, the honorable high courts have clearly stated that the approach that by the department that the rate of input is more or less same than the rate of output would not suffice. This approach of rate is more or less the same, the rate on input is more or less the rate on output runs contrary to the scheme. If there is credit accumulation due to rate on inputs more than the rate of output, even though if it is not your main input, then also you are eligible for the refund of accumulated input tax credit due to other inputs as held in various judgments. In case of Indian Oil Corporation Limited, Honorable Delhi High Court has held. In case of BMG Informatics, Honorable Guwahati High Court has held. In case of Nahar Industrial Enterprises Limited, Honorable Rajasthan High Court has time to time held that yes, even though if your other inputs rate is more than your output, then you are eligible for refund of input tax credit, accumulated input tax credit due to inverted duty structure. Next comes a question where your eligibility of input tax credit can be questioned at the time of filing of refund application. So you filed a refund application and the officer says, sir, you have taken ITC of samples, is not eligible as per section 17.5. This is the interpretation of the officer. So whether that eligibility can be questioned at time of refund application. So the adjudicating authority, without issuing of show cause notice as regards the eligibility of input or input services, cannot reject the refund application. It has been decided under erstwhile law under the following cases. In case of KKR India Advisors Private Limited, in case of Commissioner of CGST Bombay versus City Corp Services Private Limited, in Warburg Pincus India Private Limited. All these cases, time to time, honorable courts has held that the time of filing of refund application, the time of scrutiny of refund application, the officer cannot reject our input tax credit. A separate notice needs to be issued under section 73 or 74 as the case may be, and these guidelines has also been stated in circular 125, the mega master circular governing the refund application. Moving forward to the next circumstances, when when there may be a time where you may require to file a supplementary refund claim. There will be times say you are eligible for rupees 100, but by mistake you have submitted a refund application of rupees 90 only and you have got the refund of rupees 90. Now you want the differential 10 rupees refund. So, can you get a 10 rupees refund or not? It has been stated in number of cases that if any manufacturer, if any SSE, due to inadvertent arithmetical calculation has got a lower refund claim, then under those cases they can upload a supplementary refund claim under any other category. It has been decided in case of Sri Renuka Sugars Private Limited versus the state of Gujarat, is Sri KR Engineering Works versus the Union of India. Now, both high courts have decided that when a practitioner refund claim should not be rejected mainly on technical ground when the substantial condition are satisfied. Substantial conditions are satisfied only on technical or procedural ground, then the refund amount should not be rejected. Earlier, there was applications before the High Court that the refund of whether the refund of ITC on account of input service can also be availed in case of invalid structure. The Honorable Gujarat High Court stated that yes, the refund was eligible, but the Honorable Supreme Court, in case of VKC Footsteps India Private Limited, has struck down the Honorable Gujarat High Court verdict and stated that the government has specifically mentioned inputs in section 54 subsection 3 clause 2. Therefore refund of ITC on account of input services would not be eligible. However, the Honorable Supreme Court in this case pointed out the anomaly in the refund formula of Rule 89 Sub Rule 5. Thereafter, the formula was changed with effect from 5th of July 2022, wherein the input tax credit to the extent of inputs only in case where the SSC has both credit of input and input services need to be taken into account for the purpose of refund calculation. Now the question arose that the amended formula 5 amended formula implemented from 5th of July 2022 would be applicable for all the refund application prior to 5th of July 2022 or for the period prior to 5th of July 22 or not. The circular 181 clarified that no, this amended formula would apply only with effect from 5th of July 2022. But the Honorable Gujarat High Court recently, in case of Ascent Meditech India versus Union of India, stated that the amendment of the formula as per the Honorable Supreme Court direction, White Notification number 14 2022, it is a clarifactory amendment. It is a curative and clarifactory in nature and would be applied retrospectively. So if a supplementary claim or claim as per the new formula is made within a period of 2 years from the date of refund, from 2 years from the relevant date, then the refund has to be granted as per the amended formula only. So this is my presentation on refund of GST under the inverted duty structure. Now I would hand over the session to Vrinda madam for any question and answer.
Yes, sir. Thank you so much. So we have a few questions from the members. First, let's take with the basic questions. The question from Mr. Anil Agrawal Gurgaon: whether GST refund can be claimed for balanced ITC at the time of surrender of GST and due to closure of business. The similar question has been asked by Rohan Gupta Kalyan. Can refund be claimed for ITC lying in credit ledger or on discontinuance of business, and what is the timeline and procedure?
Madam, Section 54, subsection 3 clearly brings out the circumstances when the refund can be claimed of accumulated input tax credit. Section 54, subsection 3 contemplates two situations. One is exports. If you have made a zero rated supply without payment of duty or with payment of duty, for those circumstances, refund of accumulated input tax credit can be claimed. And secondly, the inverted duty structure, which we have discussed. Other than these two situations, there is no provision given under the law to claim the refund. Therefore, if any balance of input tax credit lying at the time of surrendering of business after complying with the provision of section 18, no refund is eligible and it would be lapsed.
Okay. Thank you so much, sir. Let's take the next question from BK Anand, Chennai. Jewelers have GST input and output on jewelry items at the rate of 3%. But all the expenses like rent, advertisement, etc., are at 18%, causing excess input. Can they claim such refund?
Madam, in case of inverted duty structure, it is the rate on inputs is more than the rate on output. So we need to see whether any input has been used by the jeweler on which the rate of GST is higher than the rate on output. Say rate on outward their jewelry is 3%. If they use any raw material whose rate is higher than 3%, then they are eligible for refund as per the formula given in Rule 89 Sub Rule 5. If
Okay.
as per the formula the refund amount comes, then they are eligible. So they need to check two things: rate of tax on inputs. Even though their rate on tax on input services may be higher, because the example given by the learned friend, rent, advertisement, all these are services. These are not inputs. So their rate may be 18%, but as per section 54(3), the condition is the rate of inputs must be higher than the rate of output and not of input services. So they need to check inputs. And secondly, yes, if they have inputs which rate is higher, then go to formula as per 89.5, which we have discussed. Apply the formula. If any refund amount arises, then they are eligible.
Wow, very detailed answer, sir. Thank you so much. The next question is from CA Vidur Bindal, Noida. Is refund under inverted duty structure applicable on restaurant services where the rate of outward supplies is capped at 5%, but on inputs it's between 12% to 28%?
Madam, for restaurant services, the rate notification 11/2017 specifically says the rate of 5% GST is subject to condition that no input tax credit is availed. So if credit has need not to be availed at all for paying the output tax of 5%, the question of any accumulated input tax credit does not arise.
Okay.
For rate of 5%, condition is no input tax credit is eligible. So as per restaurant, for restaurant, no ITC would be eligible. So there is no question of any accumulated input tax credit and non-refund. If any one of have taken any credit and paying tax of 5%, then they may receive a notice asking the reversal of complete input tax credit which they have taken.
Yes.
The interesting point here is, say there is a, sweet shop, a mithai wala shop, and they are paying 5% on supply of mithai under the respective HSN, and they are using inputs which rate is more than 5%, say ghee and every other items, dry fruits, the rate is more than 5%, then they are eligible for refund of inverted duty structure, but not of restaurant service.
Okay, okay. Yes, thank you. Next question from Smith Kakkar, New Delhi. He wants to know the general reasons for rejection of claims of inverted duty.
The general reasons which day in day out are coming for rejection of claim of inverted duty is as follows. The first point is a clarification regarding the nature of business. The detailed clarification, because officer sometimes doesn't understand, because we give 4-digit HSN in our GSTR1 in our output supply, so they will not have a clarity of our complete nature of business. So at the time of refund application, they seek a detailed clarification about your nature of business, nature of input and input services which you are using, what the nature of output they are using. So that needs to be taken care of. Second comes for reducing the refund application is, say if any capital goods ITC we have taken and we are treating it as an inputs. Say if any chapter 84 machinery has been installed in our factory and we have by mistake taken is an input instead of capital goods. So the refund amount gets reduced accordingly. Thirdly, as I discussed in my presentation about eligible input tax credit, so they issue a separate show cause for recovery of that eligible input tax credit. At the time of filing of refund, they check whether our supplier has paid tax or not. If our supplier not filed DSR 3B, so they may hold your refund application. You first tell your supplier to pay the tax and file GST 3B. So these all are the 3-4 issues which come up on regular basis, dealing with the reasons for rejection of inverted duty structure. But if your refund application is as per the circular 125 and 135, giving all the particulars, all the documentation along with CS certification when required and declaration, then the refund is normally not generally rejected and it is smoothly given.
Okay. So let's conclude this question and answer session. These were the main technical questions asked by our members and very well answered by you, sir. Thank you so much.
Thank you.
Let's end this Q&A session now as we have to move to the next session. But before that, I would like to extend heartfelt gratitude to our esteemed speaker, CA Anish Goyal, sir, for sharing his expertise and insights, enriching our knowledge in this crucial field of GST refund. Thank you so much, sir.
Thank you. Thank you, ma'am.
Let me inform you all about the number of participants who are attending this webinar is almost 1045. That's the great number of participants. Thank you to all the attendees as well.
Thank you, ma'am.
Let's move to the next session. For the next session, we have the speaker is CA Chunoti H. Dholakia ma'am. The topic is taxation of trust. Let me introduce her first. Ms. C. Chunoti Dholakia ma'am has written multiple articles on income tax, GST, and various newsletters, journals, and newspapers. She has served as a faculty in seminars organized by Bhuj branch and Gandhidham branch of WIRC of ICAI. She has also authored and co authored the books on tax planning practical aspects, all about trust and NGOs, expert promotion measures in India, handbook on taxation of private trust of Income Tax Act 1961, etc. With this, I would like to hand over the session to our speaker, ma'am, CA Chunoti Dholakia. Ma'am, the ground is yours now.
Thank you. Thank you, CP committee, for giving me this opportunity, and thank you, Vrindaman, for the introduction. Today, much discussing topic is issues in taxation of trust. In last 3-4 years, there are many changes have been made in provisions related to trust, and due to such changes, we are facing many issues in provisions related to trust. But there is one very meaningful quote that nothing changes if nothing changes. Nothing changes if nothing changes. To change something, it is necessary to make changes in some other things. Changes in trust taxation are made to streamline the provisions applicable to trust and ensure timely compliances. We all know that in last 50 years there were not much changes made in the field of trust, but now starting from registration to dissolution, all provisions are totally changed. We will not go much deeper into basic provisions applicable to trust. We all know the provisions from bare acts. We will cover only issues related to the provisions applicable to the trust. So, to understand, first we will see issues related to registration of trust under the Income Tax Act. Then we will see issues related to donation and other receipts. Then we will see issues related to application of income. And at last, we will see important matters to be considered to avoid litigation. So to start with the basics, we all know that Section 11, 12, and 13 of the Income Tax Act are complete code in itself. Registration under Section 12 is mandatory to claim exemption under Section 11 and 12 of the Act. And we all know that in last 3-4 years, many changes have been made in provisions related to trusts and trust registration, and drastic changes made specifically in the process of registration. We all know that no permanent registration under Section 12 and 80G of the Act. If the trust has not commenced the activity, the trust has to first apply for provisional registration, which is issued for 3 years. Then the trust has to apply for regular registration, which is issued for 5 years. And as we all know, with effect from 1st October 2023, the trust can directly apply for regular registration subject to satisfaction of some conditions. We will not go deep into the conditions. We will directly go to the issues related to registration. First issue is who can apply for registration. Section 12A uses the word any trust or institutions. Hence, any public charitable trust or religious trust can apply for Section 12A registration. Whether private trust can obtain registration under Section 12A? No, the private trust cannot obtain registration under Section 12A. Cooperative society and Section 8 company? Yes, both they can obtain registration under Section 12A. Whether religious trust can obtain registration under 80G? No, religious trust cannot obtain registration under Section 80G because, as specified under Section 80G, objects of the trust should not be related to particular religious community. Now, what? If the expenditure of the charitable trust is more than 5% of religious nature of its total income, it should always be considered that if the charitable trust has expenses of religious nature more than 5% of total income, the trust cannot apply for ATG registration. Hence, the charitable trust hence should consider that its expense on religious nature should never be more than 5% of its total income. If the trust has obtained ATG registration in earlier years, it will be cancelled also. Now, Section 12A uses the condition. Both conditions are that charitable object and genuineness of activity. What are the charitable objects? We all know Section 215 defines the charitable object. They should be related to that condition only. And genuineness of activity. What is the genuineness of activity? Activity of the trust should be actually conducted and should be complied as per the trust deed. If they are not as per the trust deed, application for 12A will be rejected. Now, the very important matter related to trust registration, which is introduced in 2023, is Section 115TD. The changes made in Section 115TD is that now Section 115TD is applicable if application for registration under Section 12 will be rejected or not filed within specified time, meaning thereby if the trust has obtained provisional registration but not applied for regular registration within specified time, Section 115TD will be applicable and the trust is liable to pay tax on accreted income. Hence, this is very harsh provision and every trust should must consider application filing considering provision of Section 115TD of the Act. Now, coming to the next issue, which is most important issue, is the date of commencement of activity. We all know that Section 12A1 AC3 mandates to file application for registration within 6 months from the date of commencement of activity or at least 6 months prior to expiry of period of provisional registration, whichever is earlier. Now, what is the meaning of the phrase date of commencement of activity? Whether it is date of incorporation of trust, whether it is date when the trust has first time received donation, or it is the date when the trust started applying its income for the trust objects. There is no clarification in the Act. The Act has not defined the meaning of date of commencement of activity, but many experts are of the view and many judgments supporting this the view that the date when the trust started applying its income for the trust object should be considered as the date of commencement of activity. But still, there are no clarification in the Act. Now, some judgment supports the view, as we have seen earlier, is that the judgment specifies that there should not be any discrimination between existing and new trust for provisions of registration. The term whichever is earlier should be applicable only to the trust which has commenced activity only after obtaining provisional registration and not to the trust which has already commenced activity before obtaining provisional registration. For existing trust, only condition should be to apply within 6 months of expiry of provisional registration, meaning thereby the trust which has already commenced activity before applying for provisional registration has to apply only within 6 months of expiry of its provisional registration. This is harmonious interpretation. Next is date of giving donation to other trust shall not be treated as the date of commencement of activity. Donation to other trust is not the activity in real sense. Activities are to be considered as commenced when the donation received is utilized for the charitable activities. This view is supported by Surat Tribunal in case of NJ Charitable Foundation Surat versus CIT exemption. Now, the judgment supporting this view are as under. First is Madras High Court judgment in case of Shri Narsimha Priya Charitable Trust, Jodhpur Tribunal judgment in case of Bamasha Sundarlal Daga Charitable Trust, Surat Tribunal judgment in case of Vananchal Keavani Trust, Ahmedabad Tribunal judgment in case of Rabdi Vibhag Progressive Keavani Mandal versus CIT exemption, Pune Tribunal judgment in case of Tibilullah Charitable Foundation Sangli versus CIT exemption, Chennai Tribunal judgment in case of CIT 1982 Charitable Trust Coimbatore versus ITO exemption. Next issue is delay in filing application due to bona fide reasons. We know that the trust is filing application before due date, but sometimes the trust is unable to file the application before due date due to some bona fide reasons, such as the trustees were out of country, health problems to trustees, mistake of accountant by treating provisional registration as regular registration, etc. In these circumstances, the circumstances are beyond control of the trust, and the trust is unable to file application for registration before due date. In this case, the trust cannot file the application before the specified date. Now, the amendment has been made by Finance Act 2020-24, giving the power to Principal CIT to condone the delay in filing application for 12-way registration. Hence, if the trust has not filed application for regular registration within specified time, the trust can apply before Principal Commissioner CIT under Section 1192B to condone the delay, and he will condone the delay and allow to file the application to the trust. But it should always consider that these powers are not given to condone delay for Section 80G registration application. Hence, still, if the application for 80G registration is not filed within the time, application for registration will be rejected. Now, in case of Best Bud Petcare versus CIT exemption, ITAT Ahmedabad held that application for registration under Section 80G cannot be rejected on the grounds of delay in filing Form 10AB due to bona fide reasons, as the circumstances were beyond control of the trust. Hence, in such circumstances, application for registration shall be granted. But we should always consider that the reasons should be always bona fide and not others. Then in that case only the application will be granted. Next is issues related to notices. We all know that CIT issues notice seeking some details before passing order for regular registration under Section 12AB or approval under Section 80G of the Act. When we are filing application for regular registration, CIT issues notice and we are giving reply to it. And then, after considering the reply, CIT accepts or rejects the application. But it happens sometimes that the notice is uploaded on the portal only and not sent physically or through email ID, any email ID. And sometimes it happens that notice mailed on the email ID other than the registrar's email ID. In such circumstances, the SSC is unable to file response as he has not received the notice either on portal or through physical or any email ID. In such circumstances, application will be rejected if no response or only part response is filed for the notice. Some judgments are in favor of the SSC, but we should consider that we must ask the SSC to check the email and file full response, not only part response. Sometimes we are filing part response and forgot to file again the balance part response. Hence, we should always consider that we must file full response and should provide each and every details as demanded in the notices. Otherwise, the application will be rejected. Now, the judicial ruling supporting this view and helps the SSC are ITAT Pune in case of Seth Bechardar Manchand Jain Svetamba Trust versus CIT. In this case, the notice was mailed, but notice was mailed on the mail ID other than the registered mail ID, which was not the mail ID of the SSC. And the application for registration was rejected as no response was received for the notice. ITAT Pune held that notice mailed on wrong email ID is not an effective notice and violates the principle of natural justice. Hence, opportunity should be given to the trust by serving the notice on the registered email ID. Another interesting judgment is Sant Kabir Mahasabha versus CIT exemption. In this case, the notice was uploaded on the portal only. It was not sent physically. Hence, the SSC had not logged in and not seen the notice, hence was unable to file response. The decision given by CIT ex parte and rejected the application due to non-submission of response. ITAT Chandigarh held that merely uploading information about date of hearing on the income tax portal is not the effective service of notice as the provisions of section 282 of the Act. Hence, CIT shall serve the notice physically as well as on the registered email ID and decide afresh for application for registration. Next issue is absence of dissolution clause in the trust deed. As we all know that the trust deed is the basic document for each and every trust. We should consider each and every matter at the time of forming a trust deed. We should not just copy paste from other trust deed, but we should consider object, name. We will see later how and which things we should consider. But we should see that the trust deed must contain dissolution clause. and manner of dissolution of trust and manner of transferring assets of the trust at the time of dissolution must be mentioned. Some old trust incorporated many years ago may not have dissolution clause in the trust deed. It may happen because at that time it was not mandatory to mention the dissolution clause in the trust deed. Due to the non-mentioning of the dissolution clause, application of registration is rejected. It happens many times. In Roop VK Jain Foundation versus CIT exemption also, the application for registration was rejected just because the reason that the trust deed has not the dissolution clause. CIT has not seen genuineness of activity or objects of the trust. It has rejected the application as there was no dissolution clause in the trust deed. ITAT held in the case that absence of dissolution clause cannot be considered as absence of charitable objects and lack of genuineness of activity. Absence of dissolution clause in trust deed cannot be sole basis for rejection of application. Now, next issue is objects for particular religious community. Some trust has included the words related to particular religious community or caste in the name of the trust. At the time of finalization of name of the trust, we should consider that the name of trust should not contain any of the word which pertains to any particular religious community or caste. There are many judgments supporting the SSE that application for registration cannot be rejected, but to avoid the litigation, it should always be considered that the name should not contain any such word. Majority of trust may not be working only for the benefit of a particular religious community or caste, but for the benefit of general public. It may happen that the trust is managed by particular persons of particular religious community. All trustees may be related to particular religious community, but the trust is actually working for general public. In such case, also CIT rejects the application for registration, considering that the trust is managed by trustees which belongs to particular religious community. Hence, the trust is working for the particular religious community. And registration under Section 12A shall be cancelled. In such cases, even if the trust has applied its income for the benefit of general public, application is rejected. Similar was happen in case of Sindhu Seva Samiti versus CIT exemption. In this case, as we can see, the name of the trust contains the word Sindhu, which belongs to particular religious community. The trust applied for 12A registration and application was rejected due to the reason that the name contains the word Sindhu. Now, ITT Ahmedabad held that actual activity should be verified for registration and not any word in name or trust indicating any particular religious community. Only due to inclusion of the word related to any particular community in the name of trust, it cannot be confined that the trust is formed for the benefit of particular religious community or caste. Now, there are many judgments which supports this view. We have covered only one judgment. Now, another interesting judgment is Sri Shruti Parampara Gurukulam Bengaluru versus ITO. In this case, the trust was providing Vedic education and applied for 12AB and 80G registration. The application for registration granted under Section 12AB under religious trust category and rejected application under Section 80G on the ground that spreading knowledge of Vedas is religious object and therefore it is formed for the benefit of particular religious community. ITIT Bengaluru held that Hindu is a way of life or state of mind and not a religion. The word Veda means knowledge and it is derived from the word Vid, means to know. Vedas contains knowledge of science, medicine, political science, psychology, agriculture, poetry, art, music, etc. Hence, it cannot be confined that Vedas are belonging to a particular religion. The activity of spreading Vedic education is charitable and not religious. Hence, registration under Section 12AB and 80G shall be granted under charitable trust category and not the religious trust category. Now, coming to the issues related to maintenance of books of accounts. After obtaining registration, the trust has to maintain books of accounts. Earlier, there were no books of accounts specified. The trust maintained the books of accounts as per the requirement, but now Rule 17 specifies the list of books of accounts which should be maintained by the trust. There are almost more than 50 books which the trust is required to maintain now. Every trust should see this list and should comply it, because non-compliance has very harsh provisions. We will see it later. Such books of account shall be maintained in written form or in electronic form or in digital form or any other form of electronic magnetic data storage devices. It shall be kept and maintained at registered place of the trust. Registered place means the place which is registered by the trust and informed to the jurisdictional assessing officer at the time of obtaining registration of the trust. The trust shall maintain the books of account at registered place only and not any other place. And as we all know, Form 10B and Form 10B be required to report whether the books of accounts have been maintained at the registered place. If no, then the address of other place, date of decision by the management to keep it at other place, and date of intimation to assessing officer that books of accounts are kept at other place. If the trust has not kept books of accounts at the registered place and kept it at some other place, the trust has to first pass resolution. It should be signed by all the trustees and informed to JAO within 7 days from passing the resolution about change of the registered place of maintenance of books of accounts. It can be informed through email also. Sometimes trustees are asking how to inform the JO. Then it can be informed through mail also, but it has to be informed within 7 days of passing the resolution. We cannot maintain the books of accounts as a accountant's office. We cannot say that it has been kept at accountant's office or trustee's office. It has to be maintained at the registered place of the trust only. And the books of accounts shall be kept and maintained for 10 years from the end of relevant assessment year. For non-maintenance of books of accounts, there is very harsh provision. Exemption under Section 11 will be denied. Now the issue is whether the trust can maintain books of accounts at the place other than registered place. We have seen earlier that the trust can maintain at other place but has to inform the jurisdictional assessing officer. What if the trust has decided to maintain the books of account at a place other than the registered place? We have seen this also. Next is, what is the time limit to intimate the jurisdictional assessing officer if the trust has decided to maintain the books of accounts at a place other than the registered place? We have to inform within 7 days from passing the resolution, not from the end of the assessment year. Now, coming to the issues related to donation income. As we all know that a major income of the trust contains donation part. And we all know that corpus donation of the trust was exempt earlier without any condition, but now Section 11(1)(d) exempt the corpus donation only if it is invested in forms or modes specified in Section 11(5) of the Act. All the trusts registered under Section 80G shall be required to file Form 10BD on or before 31st May of relevant assessment year and issue certificate to donor in Form 10BE. Hence, if the trust is registered under Section 80G as on 31st March of that assessment year, it has to file Form 10BD on or before 31st May, containing all the details of donation received during the year, including voluntary donation, corpus donation, donation in kind, grant, subsidy, each and every details of donation has to be informed in Form 10BD. It has to be uploaded on or before 31st May. And fees of rupees 200 per day for non-furnishing of Form 10BD, and it may attract penalty of rupees 10,000 to rupees 1 lakh. And Form 10BB and 10B also require to report the donation reported and not reported in Form 10BD. As we all know, Form 10BB and 10B both have this column to report the details about Form 10BD. And we has to compare the donation received as per books of accounts and donation received as per Form 10BD. It has to be matched because Form 10B and 10BB requires these details also. Now the issue is how to report donation in kind in books of accounts. Sometimes some trust receives donation in kind, such as any thing or article, such as table or any other used materials, AC or chairs, etc. In these circumstances, how to report such donation in books of accounts? Act does not specify any method of maintenance of donation in kind in books of accounts, but it has to be reported at fair market value as on the date of receipt, and it has to contain the details of the amount of donation in kind, fair market value, date of receipt, name of donor, pan of donor, all the details which have been maintained for donation is in cash. It has to be maintained for donation in kind also. Now the issue is whether donation in kind received at cost per can be claimed as exempt. Donation in kind can also be claimed as exempt if it is received in the form or mode mentioned in section 11.5 of the Act. If it is not in the form or mode mentioned in 11.5, first it has to be converted in 11.5 mode, then it can be claimed as exempt. Now the question is whether cash donation will be treated as anonymous donation. As such, cash donation cannot be treated as anonymous donation because anonymous donation means where details are not maintained for the any donation. Some judicial rulings also is available and can be disclosed. The donation received in cash cannot be considered as anonymous donation. Hence, treating the cash donation as anonymous donation is not prima facie correct proposition, but it is necessary for the trust to maintain complete details of nature, name, and address with identity of donor for all donation received in cash. Otherwise, such donation will be treated as anonymous donation as per provisions of section 115 BBC of the Act. Next issue is whether provisions of section 115 BBC related to anonymous donation is applicable to religious trusts. As we all know that provisions of section 115 BBC is applicable to charitable trust only and not to religious trust. Also, in case of recent judgment, recently one judgment came in by Bombay High Court in case of Sri Sai Shirdi Sanstha. It was held that anonymous donation of religious and charitable trusts cannot be taxed even if such trust is registered under section 80G of the Act. Hence, if the trust is conducting religious and both charitable activity, but major activity of the trust are charitable in nature, anonymous donation cannot be taxed. Now, what is the maximum limit of receipt of donation in cash by charitable trust? Many trustees are asking that how much amount of donation can be received in cash. We all know that section 269 ST is applicable to trust also. Hence, the trust cannot receive donation for any single event from any single person for more than rupees 2 lakh in a day. Hence, This provision is applicable to charitable and religious trusts, both trusts. Hence, any charitable or religious trust cannot receive donation for rupees 2 lakh or more from single donor for single event. Hence, if the trust receives cash donation from donor for any specific program for rupees 2 lakh or more, Section 269 will be attracted. For example, if the trust has received donation for any temple construction of temple in cash from one person for more than rupees 2 lakh, provision of section 269 will be attracted. We should always keep in mind that this provision is applicable to voluntary contribution as well as corpus donation also. It is applicable to both type of donation. Hence, if the religious trust has received cash donation from single donor, it has to be less than rupees 2 lakh for any single event. Otherwise, provision of section 269 ST will be applicable. Now coming to the issues related to trust, we all know that one judgment of Ahmedabad Urban Development Authority in case of Supreme Court was pronounced in last year, and it has major impact for business income. We will see it. Section 215 specifies that if the trust has object of advancement of any other object of general public utility and activity of the trust is in the nature of trade, commerce or business and such activity is conducted for a fees or consideration, such activity should be considered in the course of actual carrying out of any such advancement of any other object of general public utility, and receipts from such activity should not exceed 20% of total receipt during the previous year. Now, what is the meaning of in the course of? The in the course of used in this definition means in the course of means connected to or part of. Dictionary meaning of in the course of is during or in the process of. Hence, now it is mandatory that such business activity should be part of achieving object of advancement of any other object of general public utility. It should be connected with GPU object means advancement of any other object of general public utility. It should be essential for the trust to conduct such business activity. Otherwise, the activity will be treated as trade, commerce, or business and it will be taxed. Now, in the case of medical or educational institution, profit should be cost plus marginal markup only. Means if the trust is conducting any medical activity, suppose the trust has any hospital or the trust is running school or college, the profit should be cost plus marginal markup only. The profit should be only such that are required to run the trust, not more than that. If the profit is more than it, it will be considered as trade, commerce or business and receipt. Otherwise, it will not be treated as charitable activity. And as we all know that section 11(4)(f) defines that requires to maintain separate books of accounts if the activity is incidental to attainment of its object. Now coming to the issues related to business income, some practical issues I have covered is first is whether rental income from shops and offices owned by the trust is treated as business receipt. We see that if the rental income from shop and offices are less than cost and marginal markup, if the trust has given rent, given shops and offices on rent, at cost and marginal markup only and not more than that amount, it will not be treated as trade, commerce or business. Otherwise, it will be treated as trade, commerce or business, and such profit from such a rental income should be less than 20%, and separate books of accounts have to be maintained for such rental income. Similar provision is applicable for paid workshop or training classes. If the trust has conducted workshop and charge workshop, and trust collects fees from the attendees for the attending the workshop, or the trust is running training classes. Fees received from such classes should also be less than cost plus marginal markup. The trust has to decide the cost to run any activity first and then charge for it. Because if the trust is charging more than cost plus markup, in or significantly higher amount is charging, it will be considered as trade, commerce, or business. Now, the question is, if the activity is treated as trade, commerce, or business, then whether all expenses are deductible or no expenses is allowed as deduction. What is the situation? Uh, Section 1310 specifies the manner of calculation of income if the activity is considered as trade, commerce, or business, and as specified under Section 1310, all revenue expenditure which are incurred to earn the income of the trust are allowed as deduction in these circumstances, and no capital expenditure is allowed. But the conditions mentioned in section 1310 has to be followed. Uh, Next is issues related to application of income. We all know that any expenses will be treated as application of income if the trust has actually paid the amount of such expenses. Only the provision is not sufficient if the trust has only provided for the expense in books of accounts and not actually paid any single amount for the expense. It will not allowed as application of income. In section 48.3 and 48.3a and 48ia, TDS deduction, cash payment, all provisions which are applicable to other SSE are applicable to trust also. Hence, the trust has to comply with such conditions and such sections also. If the trust has not deducted TDS, such expenses will be disallowed also. Many of the auditors are not disallowing, thinking that provisions are not applicable to trust, but all the provisions which are applicable to other SSE are applicable to trust also. Now the issue is, what if the payment is made after filing of Form 10B or 10BB and before the due date of filing of return of income? We all know that there is gap of 1 month in filing Form 10B and 10BB and filing ITR. 30 before 30th September, we are uploading Form 10B or 10BB, and after 31st October, we are filing ITR. During this 1 month, if the any expense is paid which we have disallowed in Form 10B or 10BB, then what to do? Whether it will be allowed in ITR? In these circumstances, some judgments are supporting the view that the auditor can revise Form 10B and 10BB, stating the reason for the revision of the report, that the expense was disallowed in Form 10B or 10BB earlier, but now it was paid before due date of filing the return of income, hence it is allowed in the revised 10B and 10BB, and it will be allowed by AO in the return of income also. Next issue is whether the trust can pay salary or remuneration to trustee or any of his relatives. Many trustees are asking whether the trust can pay salary, rent, or any other benefits to the trustee or his wife or to any other relatives of the trustee. As such, there is no bar. Prima facie, there is no bar to pay salary or remuneration to the trustee. The condition is only that such benefits available to the trustee should not be undue benefits. It should be not more than the adequate which is payable to other trustees or other persons, should be paid only to the trustees and not more than that amount. as specified under Section 13, if the undue benefit is passed on to the trustee or any of his relative, which are covered under Section 13(3) of the Act, exemption under Section 11 will be denied. Hence, the trust shall not pay salary, remuneration, rent, or any other benefit which are more than the payment made to other persons. Otherwise, there is no bar in such payment. Whether the trust can claim amount spent for loan as application of income. We all know that amount from spent from loan cannot be claimed as application of income. It will be claimed as application only at the time of repayment of loan, and that too within 5 years from the end of the assessment year. Next is with whether charitable trust can apply more than 5% of its income for religious purpose. We have seen it earlier that the charitable trust cannot apply more than 5% of its income for religious purpose. If the expenses on religious trust by the charitable trust should be less than 5% of its total income. Now coming to the issues related to filing of Form 9A, 10, 10B and 10BB. We all know that Form 10B is applicable if total income of the trust exceeds rupees 5 crore, or the trust has received any foreign contribution, or the trust has applied any part of income of, outside India. In other cases, Form 10BB is applicable. And we all know the due date of filing Form 10B and 10BB, which is 1 month before due date of filing of return of income. We all know that Form 9A is used to exercise option if the trust has not received the income during the financial year, or the income is received in February and March. The trust is unable to apply the income. Hence, the trust can exercise the option by filing Form 9A and use the income in next succeeding assessment year. Also, Form 10 is filed if the trust has not applied 85% of its income during the current year. The trust can accumulate balance income, and it can be invested in forms or more specified under Section 11(5) of the Act and use it for the trust objects by filing Form 10. And due date of filing of Form 9 and 10 is 2 months before the due date of filing return of income. There is one clarification. There is no extension in the due date of filing the return of income. It is not extended due date of Form 9 and 10, but as specified by Circular 6 2023, if Form 9A or 10 is filed before due date of filing the return of income, benefit of accumulation cannot be denied. Now the issue is how to calculate the threshold limit of rupees 5 crore. Rupees 5 crore limit should be calculated considering all the income without considering exemption under Section 11 and 12 of the Act. All the income means all the voluntary contribution as well as corpus donation also. Hence, the corporate donation has to be included in the calculation of limit of rupees 5 crore. Another issue is whether foreign contribution received in rupees is considered as foreign contribution. Yes, as per FCRA, all the donations received from a foreign source, whether in rupee or in foreign currency, is construed as foreign contribution. Hence, if the contribution is received in rupee from a foreign source, even if it is received in India, it should be considered as foreign contribution, and in that circumstances, Form 10B will be applicable and not Form 10BB. Sometimes we are filing wrong form considering these issues only, and in that case, in some circumstances, we are receiving unnecessary demand that the form is not filed. We should always consider these small points before filing and selecting the form. Now, what if the trust has not filed Form 9A or 10? If the Form 9A or 10 is not filed and the income is accumulated more than 15% of aggregate of income, Section 115BBI will be applicable and tax is payable at maximum marginal rate. We all know the provision. And we have seen earlier that notice is received for filing of wrong form if we have filed form 10B instead of 10BB and vice versa. And sometimes demand raised for non-filing of form 10BB and 10BB and exemption under section 11 was denied. To save from this situation, circular number 16 2020-24 dated 18 November 2024 is issued. It is recently issued. It specifies that application for condonation of delay in filing of Form 9A, 10, 10B or 10BB can be filed to Principal CIT or CIT for assessment year 18-19 and subsequent years where there is delay of up to 365 days. And Principal CCIT or CCIT or Director General of Income Tax Act can condone the delay in filing of Form 9A, 10, 10BB or 10BB for FY 18-19 and subsequent years where there is delay of more than 365 days, meaning thereby where application for condonation of delay in filing Form 9A or 10 or 10BB is already filed for 18-19, 19-20 and 2021 before the date of this circular, delay of filing of such forms can be condoned without ceiling limit of 3 years. This circular is applicable only for the delay condone application filed on or after the date of this circular. But if Form 9A, 10, 10B or 10BB is not filed so far, the delay in filing of such forms shall be condoned only if it is fall within the period of 3 years from the due date of filing of such forms. That is, delay shall be condoned only for assessment at 21, 22, 22, 23, 23, 24 and 24, 25. Hence, at the time of filing delay condone application, we should consider these points. Now, what is the reasonable cause for delay and case of genuine hardship? As we have seen the earlier that if there is reasonable cause for delay in cases of genuine hardship, delay shall be condoned. Reasonable cause means the cause which has actually caused the delay in filing the application. We cannot say that we have filed Form 10 3 months late because there is a technical error in the software or portal. The delay which has actually caused the delay filing of the application has to be genuine, and the genuine hardship should be to the SSE in filing the application. Then only the delay condone application shall be granted. And as specified in the circular, application for condonation of delay should be disposed of within 6 months from the end of month in which it was received. Now, the issues related to filing of Form 9A, 10 and 10B or 10BB. First is, what if application for condonation of delay for Form 9A, 10, 10B or 10BB is already filed for 18, 19, 90, 20 and 2021 and pending for disposal before the date of this circular? As we have seen earlier, if it is already filed and only pending for disposal, it shall be granted. Now, what if Form 9A or 10 or 10B or 10BB is not filed so far? In these circumstances, delay condone application shall be filed only for assessment year 21, 22, 22, 23, 23, 24 and for this assessment year 24, 25 only. We cannot file application for earlier assessment year if it is not filed before the issuance of this circular. What is reasonable cause? We have already seen. Whether the trust can claim exemption under section 11 and 12 if it is filed updated return under section 139(8)(a) of the Act? No. The trust can claim exemption under section 11 and 12 only and only if the trust has filed the return of income before due date or revised the return of income. It cannot claim exemption in case of filing of updated return. Now, at last, we will see important matters to be considered to avoid this litigation. First is name of the trust should be consistent with the objects of the trust, and objects of the trust should not be related to particular religious community or caste. We have seen earlier all these points, and it should be mentioned in the object laws that trust will work for the benefit of general public without discrimination of any caste, creed, race, or religion. Also, dissolution clause and manner of dissolution of trust should be included. It should be mentioned in the object laws that power, duties, and of trustee. We have the column power, duties, and trustee should be mentioned in the power, duty, and trustees clause that nothing contained in this trust deed shall be deemed to authorize the trustees to do any act which may in any way be construed as violating or contrary to the provisions of section 215, 1023b, 1023c, 11, 12, 12a, 12b, 13, and or 80g, 40a, 40a, 3, 43b of the income tax act means all the provisions which are applicable to trust has to be followed by the trustees, and or any statutory modification thereof or any other section applicable to trust in future. All the existing provisions and the application will be applicable to the trust in future has to be followed by the trustees also. Moreover, the trust must conduct activity at cost or marginal markup. If the activity is conducted at more than such amount, it will be treated as trade, commerce, or business. We have seen the implication. What if the trust has conducted activity at more than cost and marginal markup? Also, separate books of accounts shall be maintained for the activity in the nature of business if it is incidental to carrying out the activity of the trust. The trust cannot conduct activity which is not incidental to carrying out the activity of the trust. It will be treated as trade, commerce, or business. And if the activity is incidental, separate books of account shall be mentioned for it. If the trust is object of advancement of any other object of general public utility and any activity conducted by the trust is in the nature of trade, commerce, or business and conducted for a fees or consideration, profit from such activity should not be more than 20% of total receipt, and such activity should be conducted in the course of actual carrying out of advancement of any other object of general public utility. Now, some statutory compliances with the trust has to follow every year. First is filing of Form 10BD on or before 31st May of every financial year. Then filing of Form 9A or 10 at least 2 months before the due date of filing the return of income under Section 139(1). Then filing of audit report in Form 10B or 10BB, whichever is applicable, at least 6 months prior to due date of filing return of income, and filing of return of income ITR 7 on or before due date. Thank you. If any question, I am ready. Otherwise, I am closing my presentation. Thank you.
Yes, ma'am. Few very important questions are asked by our participants. So let's take the question one by
Yes.
one. DS Prasad sir from Kollam has asked, can donation from NRE account be accepted if trust has no FCRA registration?
If the
Donation from
trust has
NRE
no
account.
FC, no. If the trust has no FCRA registration, the trust cannot accept a donation from NRE account. It has to be from NRO account only.
Okay, not from NRE but from NRO account only. Okay, thank you, ma'am.
Yes.
Next question is, income in form of interest on deposit of corpus fund is exempted or taxable? If it is taxable, even if such interest is applied for the object of trust,
Interest from FD.
interest on deposit from corpus fund, yes. corpus fund का जो fund
Deposit
बिना
from
था
corpus.
उसको deposit. Hmm.
हाँ, it is exempt because it is for corpus only, and it has been invested in the more specified. If it is not more in more specified, it will be taxable. But it is in already in the form specified, and it is not taxable.
Okay. Next question from Smith Kakkar is, if fair market value of donation in kind is not accessible, then how to account for in books of account and correspondingly in form number 10? Donation in kind.
Uh, Actually, Form 10BD is required to disclose donation in kind, but it is not allowed the deduction to the donor. But donation in kind should be reported at fair market value, and it is if it is possible to derive the fair market value as much as possible. We should try to derive the fair market value of the donation in kind at the time of receipt of the donation. Otherwise, we should report the donation in books of accounts, and we should prepare a note, and we should mention that it is not possible for derive the market value of the donation in kind. Sometimes used article we are unable to derive fair market value of the donation. In such circumstances, we should make a note that these donations are received in kind from these donors, and we are unable to derive the market value. Hence, we have not recorded in books of accounts.
Okay. Next, Sudhir Bhatia from Bikaner is asking, is newly constituted trust can apply for 80G registration if it has obtained provisional registration earlier?
Yes, it has. If it has obtained provisional registration and already commenced the activity, the trust can direct apply for a regular registration under Section 80G. If the trust should have a valid 12AB registration. If the trust has not a valid regular registration for 12AB, first it has to obtain 12AB registration and then apply for 80J registration only.
Okay. Next question is, interest earned from grant in aid received from trustee who is Government of India, can it be returned to them as per GFR rules?
I have not much idea about GFR rules, but it cannot be, as per my view, it cannot be written.
Okay. Moving to the next question from Bangalore. What is the due date for revising Form 10BB? Shall we revise 10BB for assessment year 23-24 now?
If the assessment is not still done, we can revise it by giving the reason. But if it is already demand is raised or assessment is done, then we have to file delay condone application. As we have seen earlier, the circular is issued. We can revise by filing delay condone application if we have filed wrong form, and then we can file it now.
Okay, so condonation of delay is the only way.
Yes.
Yes. Next question from Raula Kumar Hyderabad. He wants to know the advantages to registered trust compared to unregistered trust from taxation angles.
A registered trust can claim exemption under section 11 and 12, but unregistered trust cannot claim exemption under section 11, 12, and all the income which has received by the trust is taxable for in case of unregistered trust, and unregistered trust is treated as AOP, as we all know. Registered trust can claim exemption under section 11 and 12.
Okay, next question is related to condonation of delay from Vijayawada. What is the form for application of condonation of delay for application of registration which is not provisional? And also please explain the procedure. Is it required to be filled parallelly with application for rejection for registration?
Yes.
Form.
Delay, Yes, there is no specified format for delay condon application. We can file it on the letterhead of trust with the sign of any trustee. Delay condon application can be filed. It can be mailed also, and it can be attached by attached with other documents for registration. Both method are correct. No format. We can mention reason for the delay, and what are the reason, and what was the due date, and when we are filing the application. It is a request to condone the delay for following reasons. We are filing the application, and we have already attached the other documents, and our activities are genuine, hence we kindly consider to condone the delay. In this format also we can file the application for condonation of delay.
Okay, so no proper form, but we can self-write the application.
Yes.
Okay, let's take a last practical question. Can a charitable trust sell a part of the property to meet the expenses for construction of building or for meeting the running expenses of trust?
It should be mentioned in the trust deed. Otherwise, no, the trust can not sell. It should be mentioned that the trust will sell the property in case of necessity. Otherwise, the trust has to hand over all the trust property to the other trust having similar objects. If it was mentioned in the trust deed, then the trust can sell the properties by the auction and following the specified procedure, and calling the general meeting and obtaining uh, uh, ratification in the general meeting.
Okay, so passing the resolution in the meeting and confirmed by the trustee only.
Yes.
Yeah, but selling of property is allowed for such expenses.
Yes.
Okay, so thank you so much, ma'am, for all your great answers. I would like to thank CA Chunoti Dhulakia, ma'am, for sharing your knowledge and expertise on such a complex topic. Ma'am, you precisely covered the aspects of issues in taxation of trust and also showing us practical aspect of it with the stated case laws. Ma'am, many participants are asking for your PPTs that shows you have covered in-depth detail of relating to issues of taxation in trust. Secondly, I want to thank
Yes.
all. Yes, please, ma'am.
Yes, I have shared with CP committee, and it will be shared to everyone participant by
Yes,
CP
yes,
committee
definitely,
members.
ma'am. We will share through an email. Yeah. Next, I want to thank all the attendee participant members for attending this
Thank you.
webinar with a view to adapting new requirements and norms. I would also like to thank the technical team of CPE committee for your technical support and all the communications to make this webinar possible and successful with almost 1092 registered members. Yes, almost 1100 members are attending this webinar. That's great number of participants. Thank you so much. Last but not the least, let's thanks to ICAI for giving us an opportunity for this continuous learning. Thank you. Let's end this session.